Well, I've been thinking about this for a number of years. I've got 15, 20 years before I'll be looking at going on permanent holiday, and it's often traditional that you would increase your portfolio weighting to income stocks rather than growth stocks. That's my understanding anyway. But I've never really liked that idea, and notwithstanding what Roger's also already mentioned, which is the effect of franking credits here in Australia. So that muddies the waters a bit. But my basic philosophy on income stocks is it scares me. It's kind of like turning up for work every week, and that one week you turn up for work, you do your week's work, and your boss says to you, well, I'm not paying you this week. And you say, why? Well, I just don't feel like it. And that's kind of what dividends are. The directors, it's entirely at the discretion of the directors whether they pay a dividend in any particular year. And for me, if I was relying on a portfolio of 20 stocks, all of which I'm relying on them to pay me a dividend in order for me to live, that would be a pretty precarious situation. Telstra, for instance, is paying a very good dividend this year, and it might do next year, but what about in 5 years' time? And if its value is decreasing, its value is decreasing and its share price follows that value, and we've seen that in Skaffold, how over the last 10 years the share price has actually followed the value, you could lose not only your dividend, but you could also lose some capital as well. So my aim for when I get to retirement age would be ideally to have $2 million in a diversified portfolio of stocks growing at, say, 15 to 20% per annum, and then I could actually liquidate 3% of that portfolio to live on, which is about $70,000, and it's still, the remainder of it is still growing in excess of inflation. So I won't be going backwards, and I can choose which stocks I liquidate. So if they're high price, if I look on Skaffold and their share price is well above their intrinsic value, I'll say, oh, well, this year I'm going to liquidate those stocks or a portion of those stocks because they're overpriced, and I'll according to Skaffold. So that's my aim as an individual, is to look at the quality of the businesses I own, or the parts of the businesses I own, that is the quality of the stocks, and if they're growing at a good percentage each year, then I can afford to liquidate a bit of it.
Thanks, Russell. Roger, did you have anything to add to that as well?
I agree with what Russell said, and I'll share a story with those investors who are interested in this this conventional idea about income portfolios and growth portfolios, which I don't subscribe to. And I think anyone who follows Warren Buffett, or who likes the idea of the way Warren Buffett has invested at Berkshire Hathaway, will note that on many occasions he's made commentary about this division of growth and income as being a furphy. So anyone who advocates the idea of splitting the two up, really, despite any claims that they follow the Buffett approach to investing, really don't understand it. There was a company that I bought shares in a previous role as a fund manager and owner of a funds management business I bought shares in the Reject Shop when they listed, or just after they listed. This is back in 2004, and they were trading at about $2.40 shortly after they listed. They were on a dividend yield of 6%. They were generating a return on equity of about 40%. Fast forward 5 years or thereabouts, and the share price had increased materially, but more importantly, the dividends and the earnings per share had increased materially as well. And the impact of that was that the share price had gone from, let's say, $2.40. It had gone up to as high as, I think at that stage it was $16. Just having a look at it now on Skaffold. So it was 2010 rather, it got up to in fact $18. And the income had grown as well. In fact, I think I say in my book by about 2009 or thereabouts, the share price trading at about $14. The yield on the purchase price was about 27 or 30%. So my question to investors is this: was that an income stock or was it a growth stock? It was actually both, but more importantly, it was an A1 or an A2 business with rising intrinsic value. And so it's important that you stick to high quality businesses that generate solid cash flow, and what you'll find is that not only will they increase their dividends over time because they've got such strong cash flow, but they'll also increase their intrinsic value, and the value of your portfolio will rise. It is very true that we are all going to live longer than we think. Humanity is living longer. Our retirement funds are under constant pressure from inflation, and they may not last as long as we will. So it's important that we have growth in our portfolio, but I can also understand that we need some income. So my suggestion is to focus on those businesses that are high quality with rising intrinsic values and strong cash flows. And what you'll find is those businesses will be both income and growth businesses.